Hey everyone, and welcome to Boss Advisory. Today we're going to talk about how the rich and powerful avoid paying taxes. Warren Buffett pays less tax than his secretary. How does a millionaire pay less taxes than a secretary? Two types of taxpayers view taxes as a natural part of life and pay whatever the government tells them to. Others evade taxes at all cost. Let's name these people. Willful taxpayer, Paul. Tax evader, Jack. To Paul, when the government comes knocking, he doesn't view it as a big problem. Paul pays his $15,000 income taxes and moves on. He'd want to keep more of the $15,000, but he considers taxes routine. Jack, a medium-sized business entrepreneur, earns a salary from the IT company he founded. Jack's firm has grown year over year, but unlike Paul, he hated paying taxes. How can the government, which didn't help his firm succeed, steal so much of his money for nothing? Jack is liable to almost every tax imaginable, including personal income tax, sales tax, excise tax, property tax, and investment tax. With all these potential taxes, Jack started to research how huge firms evade taxes. After hearing that Amazon paid no income tax in 2018, he decided to avoid losing a large percentage of his earnings to tax. Jack researched ways to decrease his business's corporate tax and his personal tax payment. Jack found the following tax strategies. Method number 1. Writing off expenses. Most wealthy people make their money through a business, so they can deduct expenses and minimize their taxable income. Most business expenses can be deducted from income to reduce taxes. Say you manage a digital marketing agency and make $200,000 a year. Without expenses, the entire $200,000 would be taxable. Most firms incur expenses, which reduces taxable profits. If you have $100,000 in reasonable business expenses a year, your profit would be $100,000 instead of $200,000, cutting your taxes by more than half. Business lunches, office supplies, new laptops, internet connections, employee benefits, staff training, rent and leases, car expenditures, etc. are eligible expenses. As a business owner, you can write off a digital marketing conference travel. Again, only business owners can use this tax break. No wonder most business owners are wealthier than employees. Method number 2. Redirect income. The U.S. corporate tax rate fell from 35% to 21% in 2017. Amazon was able to minimize their income tax because of this. Many corporations recognize income in lower tax countries. The Cayman Islands have no income, corporation, estate, inheritance, gift, or capital gains taxes, making it a tax haven. What you earn, you retain, no computations. How much would you save if you set up a tax haven in this country? Your company made $5 million last year. Instead of paying 35% or $1,750,000 in income tax, you'd pay nothing and keep over $2 million for yourself. Caymans have strong bank privacy rules. The government has no tax treaties with other nations, protecting its offshore banking clients' finances. Offshore corporations in the Caymans are not required to submit financial reports to any government entity, and the incorporation is simple. With all these incentives, it's no wonder firms hide their revenues in remote locations. Method number 3. Netting revenues against losses. You'll know how green things are. In their first year, 20% of small firms fail. 30% of small firms fail in their second year, and 50% after 5. 70% of small business owners fail in their 10th year, making business success unlikely. Loss carry forward is one method successful organizations protect their wealth. Most firms need a few years to become profitable. In slow years, losses are inevitable. These regrettable losses are great tax avoidance instruments for the future. Like expenses, loss carry-forwards can be used to decrease your taxes. Less of your income is taxable. Method number 4. Issuing stock options. Stock options are another method corporations lower taxes. Businesses like to use this strategy. Why? First, it's an expense that reduces profits and tax liability. It doesn't cause a cash outflow for the firm. When stocks are issued, they're recorded as an expense, but no cash is exchanged. This allows the corporation to minimize profits and keep cash. Companies that utilize this method benefit by encouraging shareholders to boost the stock price. If you hold firm stock, wouldn't you try to boost its value so you can pay out your options for more money? Jack is convinced he can decrease or eliminate his company tax with these 4 options. But he has to withdraw money from his firm to live and wants it minimally taxed. He decides to lower his own tax bill. Method number 5. Use regional tax legislation. Jack has worked in Silicon Valley for 20 years. His patience with residing in the state with the highest income tax rate has run out. With a state income tax rate of 13.3% for high earners, Jack is handing over a substantial piece of his money to his state government and considerably more to the federal government, which can't be avoided. Jack wonders what he can do to avoid certain personal taxes. Jack researched states with lower income tax rates and was shocked to find 7. He could avoid a 13.3% tax he was paying and yet enjoy the sun in Texas, Nevada, and Florida. As Jack researched home choices in these 3 states, he wondered if he could cut his tax payment more. Method number 6. Real estate investment. One way the rich make their money work for them is through real estate. Real estate ownership increases wealth by creating revenue and reducing taxes. When you buy a property, you get a depreciable asset. Because the asset depreciates over time, you can deduct depreciation and lower taxable income. Common deductible expenses include home repairs and mortgage interest. The more you spend, the lower your tax bill. What happens after a property's depreciation? You buy a new property. Selling property triggers tax. A 1031 exchange allows you to delay property tax. Within 60 days of purchase, you can depreciate and sell your properties forever without paying tax while continuously renting them out. Method number 7. Deferring income. Jack has considered moving and using a real estate to decrease his taxable income, but he still feels some of it should be protected. Deferring his salary is another option. Individual retirement accounts or IRAs are the most prevalent tax deferral vehicle, allowing you to move income into a fund and tax earnings later. Employees utilize this type of account to save and expand their money. They also help evade taxes. Employment income is taxable unless you contribute to an IRA. In the year you donate to your IRA, you'll earn a tax deduction. This method minimizes high-income earners' tax bill during peak earnings. If you make $500,000 and are in the highest tax bracket, 40% of your income is likely taxed. What if part of your income was taxed at 20% instead of 40%? Yes, with an IRA, when you contribute to an IRA, you don't pay tax until you withdraw the cash, usually during retirement. During retirement, you'll presumably earn less than $500,000, so the money you withdraw will be taxed at a reduced rate. The difference in tax rates is how much you would have saved by employing this income deferral approach. With all these tax evasion strategies, you have one question. Which type of taxpayer will you be? A Paul or a Jack? Thank you guys so much for watching Boss Advisory, and if you haven't yet, be sure to subscribe, give this video a big thumbs up, and hit the bell so you get notified on every new incredible content we make for you. Have a wonderful day and see you on the next one.